Hi, everyone. It's 9 o'clock on the West Coast and 12 o'clock on the East Coast, so we're going to go ahead and get started. Hi, everyone. I'm Jen with TSIB. Welcome to TSIB's Construction Risk Management Seminar, Day 3. We are so excited to be here with you. I'm going to introduce our speakers in a moment, but first a couple housekeeping notes. This session is pre-recorded, but we will have a live question and answer at the end. We ask you that you stay on mute and off camera during the session. Andrew Waterbury and Nick Balaity are here with us today, so if you have any questions, you could post them in the chat feature located at the top right of your screen. Andrew and Nick will also be chatting with us during the entire presentation, so as you're watching the video, you can post anything in the chat. But again, we will have plenty of time at the end for questions. The entire session, including the question and answer, will be available on demand on TSIB's YouTube channel. Lastly, the material covered during the session's presentation are for informational purposes only. It should not be construed as legal advice. It is highly recommended you contact your attorney for legal advice. Again, I'm also going to ask everyone to make sure you're on mute and please turn off your cameras. So without any further ado, I'm going to introduce our speakers. This is Andrew Waterbury, and he is the Director of Surety at TSIB, and Nick Balaity is a partner at Aldrich CPAs, and they are presenting on how your company's financials are analyzed by surety companies and credit facilities. We're very excited to have you here with us. Why don't you say a quick hello to everyone, and then we'll get started.
Hello, everyone. Thanks for joining us, and happy Cinco de Mayo. That means I get to have my wife's hard shell tacos tonight, so we're excited about that. I'm the Director of Surety at Turner Surety and Insurance Brokerage, and my co-presenter, I'll let him introduce himself, Nick Balaity.
Hey, I'm Nick Balaity. I'm with Aldrich CPAs and Advisors. We're a West Coast regional firm that's focused on serving construction contractors throughout Southern California. And I'm a partner in our assurance niche. So I do audits, reviews, compilations, and a whole bunch of other stuff. So yeah, I'm excited to be here and share what I know.
Alrighty, I'm going to play the video and we'll get started soon. Thanks.
We are going to be presenting to you how your company financials are analyzed by surety companies and credit facilities. We're going to weigh a little more heavily on the surety side of things, but all things talked about are applicable to your credit facilities and overall financial health of your company. I'm Andrew Waterbury. I'm the Director of Surety over at TSIB, and my co-presenter is going to be Nick Balaity. Nick, if you want to introduce yourself.
Yeah, so I'm Nick Balaity. I'm a partner at Aldrich CPAs. We are a means I do all your financial statement audits, reviews, compilations. So I'm working heavily with contractors all the time, going over these metrics with them. And so I'm happy to kind of share what I've gleaned over the years of working with contractors.
Thanks a lot. Nick and I, we have the fortune to work together on a few clients. Actually, as well on the surety side, we obviously specialize with contractors. So Nick and I go hand in hand on a lot of clients, and it helps to have a good CPA to partner up with to help the contractor understand where they're at, as well as the surety broker to help kind of guide them as to what they're trying to accomplish. So we're going to go through that in our next slide. Well, really quickly, we want to introduce the 3 C's of surety. If you've had a surety bond program, worked with a surety broker over the years, you've probably heard this. Capital is where your resources are available to run your operation, and that's where we're really going to focus in on today. But that doesn't mean that the other 2 C's aren't as important. And just to briefly touch base on those, on the capacity side, we're really looking at, is your company able to take on the work that they have going on, and that kind of applies to staffing, equipment, the experience. So if you're looking to take a larger job, what experience do you have? Maybe you have a resume or a key employee that has worked on those size projects, and now it makes sense for you to take on that. If you're growing, do you need more equipment? Do you need more staffing? How effective is that labor going to be? If you're talking about, you have your A team, B team, if you have to bring on a third, are they going to be able to be as effective as your trained staff that's been there for many years. So those are things we look at when we're talking about capacity. Character is a huge component of what we look at on the surety side. How do you handle things when they get tough? When you have a job that is, potentially having some issues, are you going to, make sure that that job gets to the finish line? If you've had prior, when we look at your company, character kind of is twofold in capital and character, but we're going to talk about your credit. We're going to look at your credit. How have you handled paying bills over the year? Have you had a prior bankruptcy? If you have, what were the circumstances behind that? There are clients that, early in their career, when they're starting just with their pickup truck and wheelbarrow, and they kind of overextended themselves and maybe had a health issue that derailed things, or an economic issue. Did you still complete all your projects? Was it the things that when we look at character, if there was a past surety loss, that can be an issue, but something we want to make sure we're representing you as the surety broker to the surety company in a proper light, and making sure that they are comfortable with your obligations. So, like I said, we're going to focus today on the capital side, but always feel it's important to touch base on the character and capacity. So I'm going to flip it over to Nick to kind of go over kind of the bulk of what we're going to talk about today.
Right. Thanks, Andrew. So really, the bulk of what we're going to talk about today is working capital. Working capital is the primary metric that gets looked at when you're looking at surety credit, and even on the banking side as well. And so where that starts is on the balance sheet. When you look at a set of financial statements, the balance sheet is kind of the snapshot of all your available resources and liabilities. So all of your cash, your AR, that's all your current assets. And then you have accounts payable, retention payable, that's all your current liabilities. So you get to and there's some other stuff that we'll dig into a little bit more, but you get to this calculation for working capital. And so working capital is kind of shows what resources are available to complete each job, and what's going to be available in the short term for that. So the idea is within the next 12 months. So that's kind of your first gate, right? So once we get to the working capital that we really think is necessary to fund operations at the level that you want to be at, then we go ahead and switch over to working capital ratio. And working capital ratio is kind of, we've already figured out we have the working capital we need, but do we have more than we need, or do we have more, excuse me, I should say, do we have excess current assets over our current liabilities that we could use somewhere else that maybe can be used by owners personally, or maybe we can invest in some other assets or things like that would further our financial goals as a company. Andrew, do you have anything to add on that?
Yeah, there's going to be a couple points that we're going to make throughout the slide. It may seem a little redundant, but it's kind of important to reiterate those things as we go through. Just when we're looking at working capital, that is your basis for your bond program. When we're looking at your aggregate, we have your single job size, which is based off your experience, which a bond company will usually lend 1.5 to 2 times your largest job, will be kind of make up your single limit. Your aggregate limit is based on your working capital, depending on what type of contractor you are, whether you're a general contractor or a prime sub. We look at, but rule of thumb, working capital will dictate 10 times your aggregate bond program. So we're going to go into that. I just want to touch base here when we're looking at your current ratio. So once we fulfill your working capital based on the program you need, we start really keying in on the working capital ratio to see, is there assets available to invest in the company? Maybe it's buying a building, start taking money out, tax planning, investing outside personally. So those are the things we're going to touch base on. So I'll flip it over to kind of talk about our working capital. So when we're looking at our current ratios and current liabilities, we have your current assets. This is the bulk of what we're looking at. In this chart here, we kind of have the order, or I should say table, we have the order of importance, I'd say. Cash, we're always looking at how your cash balances are. Next, we're looking at your accounts receivable and retention. So it's important that we understand of your receivables, what's retention, because we are disallowing, which we'll see, 90-day receivables. So we want to be able to identify, hey, these aren't past due receivables, this is retention. Under billings, when you have done work that you have yet to bill for. We want to be able to recognize that, and that's why it's important to work with a good CPA that can help you identify that. If you're just going off internal financials, not everyone does a great job of doing under and over billings internally, so it doesn't give us a true depiction of where you're at. So that's why it's key. If you're doing jobs over $1 million, you should bank on working with the CPA to provide financial statements. Flipping over to the current liabilities, we're looking at your line of credit. I put that as the number one thing, because if you're in and out of it, or if you're constantly into your line of credit, well, that's something that there's covenants on that we have to pay down often. So that's where a lot of cash is going to end up going to immediately. Current portion of long-term debt, we can understand that that's kind of dictated in the terms of your loans. So we understand that we can kind of budget for that, what cash needs to be allocated on that. When we look at accounts payable, we're looking at in relationship to your accounts receivable and cash balances. We're going to go into that a little further. And over billings, we're also going to look at that. We'll touch base on that later. So, Nick, I don't know if you have anything else to add on, or if we.
No, the only thing I want to say that you touched on is the cash balance, right? That's always the most important thing. That's our most liquid asset. Cash is king, right? It's very tempting when that cash balance starts to rise to want to distribute out that cash or maybe use it in another way. This is where it's really important to make sure you're on the same page with your CPA and your broker or your banker, and make sure that, hey, if we start taking that cash out, how are our metrics looking? Going back to this working capital calculation. So just a little bit there. I know it's really tempting to take it out when you start to accumulate more cash than you've had, but just make sure that you're running through kind of the calculations on where you're at before you start to go down that road.
Yeah, Nick, that's a good point you make on the cash, and specifically as it stands right now in the environment we're in of uncertainty economically. When we have heavy cash balances, there's a lot of our best clients, they are really, we don't like to carry debt. We want to make sure all of our subs are paid, our suppliers are paid. The one thing to be mindful of with cash as it stands today is how well are you being paid? And keep an eye on that. If things start to slow down and you're stretching out to 45, 60 days from your owners and general contractors you're working with, you might need to be mindful of how quickly you're releasing that cash too. So not only is it distributing it for other things outside the company, but also within the company, keep an eye on that, because when things get tight economically, we start to see things slow down. If you've already released all that cash, you could put yourself in a very tight situation, and cash flow is everything in construction. So just to keep an eye on that. I'll flip over to the next slide for you, Nick.
Yeah, so what we want to do is give you a condensed balance sheet to look at. Hopefully each of you have seen something like this. We excluded the long-term assets, liabilities, and equity just to kind of make the illustration a little simpler. So we can show you that calculation of working capital on this client, which is a general contractor. So we have our current assets, which we're highlighting for you in A. We have our current liabilities, which we're highlighting for you in B. So we're showing you how we come up with this working capital calculation of almost $4 million. Same with the current ratio. We're arriving at a 1.21, which is a little on the thin side, but within the acceptable range. Now, as Andrew kind of alluded to a little bit before, there are some common adjustments to your working capital calculation and current ratio calculation. And so I wanted to go through a few of those, and then Andrew will probably hop in a little bit on it too. But your AR or contract receivables that are over 90 days, those are going to get scrutinized, because the question is going to be, well, why aren't we collecting those? 90 days is it generally accepted? Pretty much everything should be collected within 90 days unless there's potentially a problem. And so that we may take out the over 90-day AR from our AR calculation, which will then decrease the working capital. So something to know, if you're getting your reviewed financials, let's say in February or March, you should have an idea of how much of that over 90-day AR at 12/31 has been collected subsequently. And so that can get added back into your working capital calculation, if it was taken out beforehand. Some other things to keep in mind are related party payables and receivables. So if we have a a shareholder payable potentially, or payable to another company that's under common ownership, we can subordinate that to the surety company or the bank, and that can potentially be deducted out of our current liabilities. Same thing on the receivable side. Depending on your bank or your surety, they may actually deduct that from your assets, just based on, is their ability to pay, is there a formalized agreement, have they been showing that they've been paying, things like that. So those are just things to keep an eye on and be talking about with your broker, banker, and CPA. Intangible assets, things such as like goodwill or trademarks, things like that, while they do represent some commercial value, there's really not an ability to use that as a secured asset of any type. So typically those are removed. And then inventory, it really depends on your bank or your surety company, but they typically do some sort of a haircut on inventory, just because we know that some of that inventory is probably slow moving. We know that not all that inventory is probably going to get used in the next 12 months. Some inventory may be obsolete and need to be written off. So there's going to be some sort of a discount on the current portion of that. Andrew may have a little bit to add there, and then he can talk about the other two, outside net worth and depreciated equipment.
Yeah, inventory, I think the key word there is obsolete. If we're already applying it, it's going to show up in the job costing, so we're not going to catch that really as kind of a stagnant inventory. So yeah, we need to have a conversation on what that is depending on your trade. There might be something where you do have a inventory that will be utilized, and there might be a cost savings to you as to when you purchase that to why you would house that inventory. So yeah, we take that conversation, and we take that to the bond company to make our case if need be. Kind of roll into the next two common adjustments. It goes hand in hand. So we have outside net worth consideration and consideration for depreciated equipment. If we kind of take it, kind of look over here back at the working capital bullet points, we say, our aggregate bond program is typically 10 times your working capital. So if we look at this example, we're roughly at a $40 million aggregate bond program. Well, depending on what your needs are and what we feel is a good bond company for you, some bond companies want to see the assets held within the company and make sure that the working capital ratios meet your aggregate bond program. There's other bond companies that do a good job of looking at your global net worth. So what that means is what's your company, if you have other entities, as well as your personal assets. So, when we're looking at your indemnity package, you're indemnifying your company, you're also indemnifying your personal assets as well as other entities. So it makes a lot of sense to go pull in these other assets from your other entities and personal net worth to kind of make a case for a bond case. And we take that, like I said, we look at your scenario specific to you, make sure we're finding the right bond company to fit your needs. So those are things we can't take into consideration. Another one is the depreciated equipment. If you're a heavy equipment company and you have equipment that's fully depreciated, sometimes we can make the case to help push you over the hump and say, well, look, let's get your insured values of your equipment, and it's all depreciated. Well, maybe we have a couple million, $10, $20 million in equipment that we are using regularly that we can also help push us over the hump to get us the bond program we need. So that's where we're at. You guys will all get these slides. So if you need to study these a little more, those will be available to you later.
And just to add real quick before we switch over, Andrew, the outside net worth consideration and depreciated equipment really illustrate why it's important to have a quality broker that understands your trade. Because the heavy equipment piece is very important for depreciated equipment. Yeah, it doesn't go into working capital. That's more long-term asset, but it does show up in equity, and ultimately what, God forbid something happens, the surety company does have something that they can use as security or collateral. The outside net worth piece, as Andrew was saying, it really is dependent upon the surety company, and having a broker that understands which companies have which appetites are really important. So making sure that you're with the right broker is really important there.
Thank you, Nick. we're gonna just touch base. We've kind of already said a few of these things, so I don't want to spend too much time, but there's some working capital focal points. Cash is everything. How liquid are you? You know, I think we all know that they say cash is king, so we should be trying to keep those balances as hefty as possible. Another thing to be conscious is your receivables versus payables and current debt. So basically, do you have enough when we're looking at your current liabilities and we just dissect it to the receivables and payables? If we have $1 million in receivables and we have, you know, $3 million in payables and current bank debt, well, we better see that sitting in cash. You know, it's pretty healthy to see. The other thing when we're talking about when we start getting pinched for payment from those above us, whether it be an owner or general contractor we're working with, we want to make sure our receivables exceed our payables. Okay, we don't want to get too far ahead because we want to make sure we're floating within the scope of our contract downstream so that we're not getting pinched cash flow wise. So we keep an eye on that. There's been conversations I've had where there's some of my clients are really great pays to their vendors and subcontractors. And when we start to see the receivables kind of get to even or slide below, we want to start saying, okay, well, what we need to evaluate the way we're doing things, especially as we're running into a tough time. So just something to keep an eye on. All these things are just to keep an eye on and be at least aware of, so we can, you know, when we get those financial statements, we can have that conversation with your CPA and your broker as to, okay, here's what today looks like. What do the next 3, 6, 4, 5 months, year look like, and how do we need to adjust on what we see coming up ahead? Nick, do you want to kind of touch base on some of the late stage underbillings and bank?
Yeah. So late stage underbillings, just to touch on it briefly, the concern with late stage underbillings is a couple things. First off, are we going to actually be able to bill that amount, right? So you know, if we're getting to a job that's 95% complete, and we have these underbillings, is there some sort of deductive change order out there that hasn't been recognized? And so, you know, underbillings in general are an asset, but if they get too large, they create questions as to ask, you know, why do we have underbillings? And especially when we get to late stage, then it's really like, you know, there shouldn't really be too much out there that's unbilled. So that's why we're going to ask that question, because it could indicate that the job's not doing as well as we had previously stated it would, or as we're stating on our current WIP. So that's something to kind of keep in mind when you see those late stage underbillings. They may make sense. It may be that there's some sort of schedule of values where there's just a really large milestone at the very end where you're going to get paid, but it's going to be, you know, highly scrutinized.
Yeah, just to jump in on that point, you know, it's just important to have the dialogue. So what, you know, when we get your financials, it's a point in time. Things may have changed from that 12/31 statement till 3 months later, and you said, yep, we billed for it. It's actually already collected. So all we need to do is have that conversation. If it's still lingering, you know, that 3 months after that date of the financial statement, now we need to understand a little bit more. And I need, you know, as the broker, we need to be able to translate that information to the bond company and say, okay, is this a change order? Is this an unimproved change order? You know, that's where the bond company start to, you know, worry about, especially when we get into tougher times. And I hate to keep saying that, we're kind of in the question mark as to what things are going to look like. You know, we're all very optimistic, but if we saw that during the Great Recession, where change orders went away, our ability to make money on change orders went away, and we are going to be conscious of that now. So we just need to have that dialogue so that we can relay that information to the bond company. I'll touch base a little bit on the bank line. If you have anything to add, Nick, go ahead and jump in. But as far as bank line of credit usage, subcontractors tend to be in and out of their lines more often. And that's because, sorry for saying this, those GCs tend to cash flow a little bit off the subcontractors. There's retentions they can withhold. So we understand that with the subcontractors. General contractors, because they have that ability, like I just said, we don't typically want them in their line of credit. We want them to have it. A line of credit is kind of a financial insurance policy or safety net, if you will. You want to have it. I would encourage everyone. I know there's the PPP funding, and a lot of us were able to receive that, which is great. But I would encourage you right now, as a profitable company, to continue to have conversations with your bank or about pushing your lines of credit up because we don't know what things are going to look like cash flow wise over the next 12, 18 months. So it's better to have the conversations why balance sheets are healthy than when you actually need it. So that's kind of all I have to say there.
Yep.
Okay.
Cool. And in the interest of time, I'll move a little bit quick through the profit and loss because it is important. But primarily we're looking at working capital and the balance sheet. The profit and loss, just to clarify what that is, in case you don't know, it really shows the performance of a company over a certain period of time. We typically look at that annually when we do reviewed or audited statements. When we're doing internals, we may be doing quarterly, but just how have we done over this period of time? And the three primary things that we're going to be looking at are net income, how much money we make, right? That's the bottom line profit. Ultimately, that's what we're all in business to do is what do we get to take home, right? What are we getting to reinvest into the company? What do we get to take home for our personal goals? The second would be gross profit margin. Is that appropriate with where your industry is, right? So if you're a trade or a subcontractor, you may be seeing gross profit margins of 20, 25, 30%, something like that. Just depends on the trade that you're in. If you're a general contractor, you're probably seeing closer to 10 or less. It really just depends on your industry. So we're going to say, hey, where are you looking in comparison to other contractors in your field? And does it look right? And then operating expenses. This is kind of your overhead or administrative costs. Really, what we want to see is less than 10% pretty much across the board. That's the general consensus. Now, if you have high profit margins and you have higher operating expenses, that may be fine. But obviously, we want to make sure that our job margins, let's say we're making 20% on jobs, are higher than our operating expenses, right? Otherwise, we're losing money. So, yeah, we'll go ahead and hop into the profit and loss example here. And so we just kind of wanted to give you an idea of how it calculates. This is the same contractor we saw the balance sheet for. They are pretty much a paper GC. So they have lower profit margins at 7.8%, but they have very low operating expenses at 1.6%. So their net take home after other income and income tax expense is 6.4%. That's a pretty healthy net income. Anyone who's getting to the point that they're getting 5% or more on their revenue is a pretty healthy company. And I don't know, Andrew, if you wanted to talk a little bit about distributions. They are taking out the majority of the profits and distributions. And so I know you have a little bit to add on
Certainly,
that.
Yeah, no, I think that this is where the fun conversations start to have with our clients. There's a point in every companies where they're building. They, need more bonding capacity, need more credit. So they're leaving all the money in the company. And then there's a point in time where we say, okay, we've achieved what we need in the company. And now what do we do with those excess, I should say, those additional net income that, okay, now it doesn't make sense to leave it in the company. Now we need to go reinvest it out personally or whatever it may be. But those are the conversations where you have with your CPA, your broker. Where am I at? What do I need for what I'm trying to accomplish? And then start planning on what to do with the distributions when it's time, or increasing your salary. Those are the type of conversations you want to be having with your CPA and your surety broker. A couple things, we look at when we're looking at profit and loss focal points. Your profit margins are going down, and are you making adjustments to your overhead? So if we're talking about now, we're getting more competitive out there. The Turner Cost Index has shown that it's gone down, and it was the first time. Last year was the first time in over a decade that it had happened. So now we're starting to see it be more competitive. Are we making adjustments? And the important part of, we looked at that balance sheet, we looked at that profit and loss statement over 1 year. One of the things that we do with our clients on the surety side is we do a trend analysis, and Nick, I believe, does some benchmarking. And it's important to understand what your company looks like over time, and how does it operate when profit margins come down? How does it operate when backlog starts to shrink? There's different things that you want to at least identify, know how your company operates. How does it operate at different revenue levels when you have to add more people, expanding and contracting? And that's what you get from a trend analysis, and why it's important to really have a broker and a CPA that work with you in that capacity, because otherwise we're just telling you, hey, this is what you did this year. Well, great, but how do I behave when things are differently or are changing? That's where you start to understand the characteristics of your company, and we really kind of see some of those right here identified. As our profit margins may go up or down, how does our overhead look? As our backlog starts to shrink or delay, meaning our cost to complete is not as significant, how does our overhead need to be adjusted? When we look at your work in progress versus your cash flow, maybe Nick, you can kind of jump in there and then dive into the PPP loans for us.
Yeah. I mean, so obviously we want to understand our backlog as it relates to our cash flow coming in. And I think there's probably a better slide that we have coming up to kind of go through that, but really just understanding, do we have cash flow that supports all the jobs that are in progress? And that comes back to working capital. That comes back to knowing our cost to complete, which we'll look at in a minute. But really PPP, this is going to be a topic of conversation on pretty much every financial statement this year. And if you got a PPP loan too, next year as well. But really we want to know, if you have, your CPA should be putting that income down in other income. So we should be able to see how the company is performing before other income. But PPP this year is really going to distort net income for most of our contractors out there, depending on if they elected to recognize the revenue in 2020 or 2021. That's another conversation for you to have with your CPA. But how do we perform without the PPP? How do we feel like we're performing going forward? Maybe we had some jobs get shut down or delayed, but since then have done really well, and that's not reflective. So really, it's just a matter of having that conversation with your banker, having that conversation with your broker and your CPA, and making sure that everyone kind of understands where the company is trending and where we're going to be going in the future. And then lastly, if we've had a real bad hit from COVID-19 or whatever else is going on that PPP is not covering, do we have outside net worth to bring in more capital? Do we have outside partners we can bring in to infuse the company with capital? Do we have lines of credit available? All that info will be helpful if we're having a downtrend. So,
yeah, and I think there's a bigger, deeper conversation on the PPP that we could spend a whole nother hour on. But the gist of it is be in communication with your CPA if you're utilizing bonding. Be in communication with your broker as to how your surety company is analyzing PPP if it hasn't yet been forgiven. If it's already been forgiven, you're in a good space. But there's some different things that we're seeing. Different companies are doing different things depending on how much money you got in the PPP funding, and whether they're putting it long term, forgiving it fully, if they expect to audit, those type of things. So you just want to be in communication to understand what from your broker, what is your surety looking at the PPP loans as.
And I think, Andrew, we're about to run out of time, so let's just go through this really, really quickly here. This is an example of our contracts in progress schedule. You can kind of see our contract totals on the left. That's our estimates for the total that we're going to expend on each contract. There's our from inception to date. That kind of shows us how we've done so far. And then we have our balance sheet, basically how much we build, are we under or over build, and then our current year performance on the far hand side. And so really we're going to look at this to look at how are our current jobs performing, how have our jobs performed in the past. It'll be used as kind of a jumping off point for discussions about the status of each job.
So we talked about the under billings, we talked about the over billings. We'll kind of leave it here for those are conversations that we would have with you as to when we identify those on the work in progress. We talked about what the bond companies want to know about under billings, what they want to know about over billings. Nick, do you want to talk about?
Just really quick for tax base. Most of the time, if you're cash basis, there's going to be a lot of different methods we can use for tax, which may include cash. And that will look very different from your work in progress. So your taxable income could look very different than your book income, and you could end up using your work in progress as a method to kind of manipulate that sum too if you're on an accrual basis. It's just really important to be in close contact with your CPA when finalizing your WIP, because there can be some pretty heavy implications from your WIP to what your kind of tax liability is and how your tax planning goes. So I just encourage you to stay in contact with your CPA and make sure you're working with a CPA that really understands construction, alternative minimum tax, and which types of contractors are subject to that.
And to kind of sum it all up, to tie everything we talked about, working capital versus really your cost to complete. So when we talked about your working capital makes up your aggregate bonding program, well, that is also based the amount of capacity you have available left in your aggregate bonding program is predicated off your cost to complete. So that is where that work in progress statement, that column that shows how much cost do I have left on the existing projects, that is where we kind of look at that to see what is your current available bonding capacity on the aggregate side of things. So one of the things we do with our clients, have started to do more of, is kind of how do we look at what we have bonding wise versus what we need. So one of the things we do is we take the working capital, okay, we take basically that ratio that we talked about. This one is an example, not from the balance sheet that we utilize, but we take the working capital, we multiply it by 10, then we kind of get your rule of thumb working capital as it applies to aggregate. And then we take your cost to complete and we overlay them, okay? As long as that blue line is staying above that orange line, we're in good standing with as far as our financial working capital goes to our cost to complete. Now there's different things, as you see on this example, they intersect, and this is over a 3-year trend. So as they intersect, well, there might be, hey, we just had to fill up our backlog with really good work, okay? Or maybe the conversation is when they intersect, we have the net worth to help the working capital, or maybe we have the depreciated equipment that we can inject in more heavy equipment. So that intersection of where the cost to complete goes above the working capital, that is where it is very dire to have a good broker and a good CPA to help you communicate those things to your surety broker, your surety carrier, as well as banks. Banks look at these things in a little bit different capacity, but if you can translate this information to them before they ask the questions, you're already ahead of the game. So we're going to open it up to questions. I know we zoomed through a lot of information. Nick's information is here, and we'll get that out to you if you have any questions as far as the financials go. If you have anything in regards to your surety program or the way things are being evaluated, or if you're kind of gearing up for more bonding, which is something we're seeing a lot of right now, feel free to reach out to us. But at this point in time, we're going to go ahead and open up to questions.
All righty. Thank you, everyone. That was our presentation for today. So we have a few questions. First question, what are some examples of how to increase your bonding program with assets outside of the company?
Yeah, I'll go ahead and take that. We kind of addressed it there in the last slide. Really, we're looking at when we're looking at your global net worth, it's important for your broker to understand the full makeup. Maybe you have a real estate entity or equipment rental entity. And when you're working with your CPA, and I think Nick and I have actually done this recently with the client we've worked on together, does it make sense to do a combined financial statement? And we've even gone to the extent on some very large clients that have very large personal net worth, we can kind of do an overall combined if it really bolsters what we're trying to look for. So having a broker and a CPA that are in touch with where your assets lie and knowing what market, whether it be a Travelers, Liberty Mutual, CNA Surety, what their appetite is, and where, if you're someone that holds assets outside of the company, there might be a better fit for you. So just analyzing that with your broker and your CPA is very important. So everyone's a little bit different in the way they do things, but strategizing, if you need to collateralize something, if you're working with a bank to increase your line of credit, maybe the assets aren't in the company, but you have other assets can secure it, just working with those resources is helpful. So.
Awesome. Thank you. The next question that I see in here, are we seeing PPP loans being easily forgiven, and have you seen any audits?
Yeah, I can take that one. I've definitely helped some of our clients with that process. It's definitely been pretty easy, I would say, for our contractors under 2 million. Now there may be some back and forth with the bank. Certain banks are doing a better job, I think, of kind of looking at the supporting documents and make sure it's all straight before it gets submitted. The SBA ultimately has to sign off on it. But when you get over 2 million, that has been taking quite a bit longer, just because that's over the 2 million threshold where the SBA takes a little bit deeper look into that application. But again, I have received word from a couple of my clients over 2 million, they have gotten that forgiveness. So it's not like that's being held up. It's just taking a lot longer.
So we have another question here. Do sureties prefer cash collateral or an ILOC?
Yeah, I could take that. So irrevocable letter of credit is the reference to the ILOC. It again depends on your position. I mean, cash collateral is probably the easiest way to transact if you're, pushing your bond program and you have excess cash and you had this, say your normal project size 10 million, you come across a $20 million project that's an absolute moneymaker and you have assets outside of the company that we can secure, whether it be marketable securities or cash. That is the path of least resistance. Now, preferentially as a broker, I would advise you to maybe set up an ILOC where you can put your money somewhere else with the bank and get an ILOC set up so that you can earn interest on that and have a couple more layers removed from the bond company just holding on to your money. So I would prefer to have my client, if they're in the position to set up an ILOC, but the path of least resistance would be to put cash collateral or marketable securities or even put up a property if there's equity. So hope that answers your question.
So we have one more question I see right here. What should a company key in on with under and over billings?
I can take that one, and if you have anything, Andrew,
Yeah.
you can hop in. But yeah, I mean, I think we talked about this a little bit during the presentation. Really, the key piece is how big is it, right? Like some smaller ones that that we're tracking pretty close to our billings. It's not a huge issue. The easy one is overbillings. They should be easily explained by either, we were able to bill more up front, which is great. So we get to use the project owner's money to kind of fund the project and maybe some other stuff, So that's it's kind of seen as a good thing as long as it makes sense. On the underbilling side, we talked about it. It gets a little bit more, why, right? The why becomes a lot bigger deal at that point. If we get to a point where we have something that's material to your financial statements, we could be talking, let's say it's like a $500,000 underbilling on a contractor that does 20 million, right? That's a pretty big underbilling. And so our question is going to be the same thing that we kind of went through in the presentation. Is there change orders out there that maybe are going to increase that contract amount and it make more sense, or excuse me, is there deductive change orders that are going to make that make more sense? Is there an issue with the ability to collect on that amount? Those are the primary concerns. Do we need an updated contract estimate amount because the job's not performing as well? My big thing whenever we get to like large under over billings, I talk about with all my contractors is you just need to be able to explain why and understand, that why may be interpreted in a couple of different ways depending on who you're talking to.
Yeah, I think Nick, you hit the nail on the head. It's really being able to explain and understand it. And when we're talking about overbillings, when we're seeing that consistently overbill, like that you're doing it strategically, right? It's just not by happenstance if it's a consistent thing. It's really just being able to understand, because we're going to track from your year end, and then if we get your mid-year financial statement and we look at those underbillings, did those things translate? If not, there's a big question, and now the validity of the financial information you're providing, now becomes a problem. So, yeah.
And I will say, I kind of thought of this a second ago, like if you have a large underbilling once and you can explain it and it all makes sense, that's going to go a lot longer way than if you're someone who's, you're a contractor that's chronically underbilled. What was the result last time? That's going to really indicate, how well that's interpreted. If we had a large underbilling in the past and it did result in a job fade, you might not get the benefit of the doubt from the carrier if that's a continual problem. And so making sure that you have an accurate WIP, even when it's ugly, can really help you in the future, because then the surety or the bank feels like they can still trust the number.
Yep.
Awesome. Thank
Agreed.
you very much. So that is all the time that we have for today. Thank you very much for spending the day with us. Don't forget to join us for our next session, Is a Captive Right for You? That session's link can be found in the seminar program page on TSIB's website or the reminder of event email you receive. Thank you.
All right. Thank you so much. Thanks, Nick.
Thank you.